The biggest threat to the US economy right now isn't AI going sideways. It isn't China making moves. It isn't whoever's sitting in the Oval Office running their mouth on Truth Social. It's something so boring that most people's eyes glaze over the second it comes up. And that's exactly the problem, because the boring stuff is precisely what wrecks you when you're not paying attention. Here's what's actually going on. You've been wondering why mortgage rates won't budge, why stocks randomly freak out every few months for no obvious reason, why the Federal Reserve keeps hinting at rate cuts, but your financial life still feels like it's being squeezed from every direction. The answer doesn't start in Washington. It starts in Tokyo, and it runs through the most unglamorous asset on the planet: Japanese government bonds. I'm Jimmy, and this is Finance Misfires, where we cover the financial system failures and money traps that the mainstream won't touch because they don't get enough clicks to matter. Stay with me, because this one actually explains everything. To understand why Japan is quietly pulling the rug out from under global markets, you have to rewind about 30 years. In the early 1990s, Japan's asset bubble imploded, real estate collapsed, equities collapsed, and Japan entered what became known as the Lost Decades, a 30-year stretch of economic stagnation so complete it looked like someone hit pause on the entire country and nobody could find the remote. No real growth, no inflation, no meaningful wage expansion, just a flat line. So the Bank of Japan did what every central bank does when it's completely out of ideas. It cut rates, then cut them again, then pushed them below zero. And even when that wasn't enough, they rolled out something called yield curve control, which sounds like a Marvel villain's master plan, but really just means we are going to cap long-term bond yields whether the market agrees or not. For decades, Japanese government bonds yielded essentially nothing. And that single fact quietly broke something in the global financial system in a way that's still unwinding today. So here's where it gets interesting. When your domestic government bonds are paying you basically zero, and you're managing $1 billion portfolio for a Japanese pension fund, a life insurer, or a major bank, you've got exactly two options. One, you accept zero return and explain to your clients why their money is doing absolutely nothing. Or two, you go shopping overseas. Japan chose option two. What followed was a multi-decade global capital shopping spree that turned Japan into the largest foreign holder of U.S. treasuries, one of the biggest buyers of U.S. mortgage-backed securities, and the world's largest net creditor nation, which is just the formal way of saying Japan became the world's ATM, quietly funding the American financial system while most Americans had zero idea it was happening. And the math behind it was straightforward, almost embarrassingly so. Stick with the math here for 60 seconds, because once this clicks, you'll never look at a Fed press conference the same way again. Here's how the trade actually worked. Meet Tom. Tom wants to make some real money, so Tom walks into the Japanese credit markets and borrows yen at near zero interest rates. Then he converts that yen into dollars and drops it into U.S. treasuries yielding around 4%. After hedging costs and fees, Tom pockets the spread and calls it a day. That's the yen carry trade. Borrow cheap in yen, deploy into higher-yielding foreign assets, collect the difference. And when your borrowing costs are sitting near zero, you don't just stop at treasuries. You buy tech stocks, you buy real estate, you buy into emerging markets. Basically, if it's breathing and it yields more than 0%, it's on the shopping list. At its peak, some major banks estimated the total size of the yen carry trade was sitting in the trillions. For years, global markets were essentially running on Japanese liquidity, like the entire financial system was borrowing Japan's Wi-Fi and nobody bothered to ask for the password. For 30 years, that Wi-Fi never cut out, the password never changed, and markets built their entire architecture assuming it never would. But the whole thing rested on one assumption, a single load-bearing wall holding the entire structure up, that Japanese yields would stay near zero forever. In 2024, that assumption cracked. The Bank of Japan ended its yield curve control policy and raised rates for the first time in 17 years, then raised them again. The market's reaction was immediate and ugly. The S&P 500 dropped 6%. Japan's Nikkei 225 plummeted over 12% in a single day, its worst single session since 1987. And before you write that off as a Japan problem, your 401k felt that day. Your mortgage rate felt that day. You just didn't know why. That wasn't a random market tantrum. That was the system signaling that the trade holding global liquidity together for 30 decades was starting to come apart at the seams. Because when Japanese yields rise, borrowing in yen gets more expensive, hedging currency risk gets more expensive, and suddenly Tom's free money trade isn't free anymore. That 4% treasury spread that looked like a no-brainer yesterday looks a lot thinner today. And when the math flips, the capital flows flip. The money that spent 30 years flowing out of Japan started flowing back home, and that process has a name. This next part is the piece the financial media completely skips over, probably because explaining it properly takes more than a 30-second clip. Repatriation, and it's one of the most underreported threats sitting in global markets right now.
Here's where most people, including a lot of folks who consider themselves financially literate, get completely turned around. Everyone's locked in on Jerome Powell. Every Fed press conference gets dissected like it's a new iPhone drop. Every word choice analyzed, every pause scrutinized. And meanwhile, the actual lever that controls long-term financial conditions is sitting right there in plain sight, completely ignored. Because here's the thing the financial media won't tell you straight. The Federal Reserve controls short-term rates, the overnight rate. That's their lane. But the yields on 10-year, 20-year, and 30-year treasuries, those aren't set in Washington. Those are set by supply and demand, and right now, the supply and demand picture for long-term U.S. debt is quietly getting worse. Ray Dalio, founder of Bridgewater Associates, the largest hedge fund on the planet, has been saying this for years. His core argument is that the bond market is the actual backbone of every other market in existence. It's the baseline, the risk-free rate that every other asset valuation gets built on top of. Dalio's position is that when the supply and demand balance in the bond market breaks down, you get a very specific and painful chain reaction. Long rates rise relative to short rates, the currency weakens, gold climbs, and capital starts rotating out of bonds entirely. And when that happens, it puts the Federal Reserve in a bind that rate cuts alone simply cannot fix. That's not a fringe take. That's the founder of the world's largest hedge fund telling you everyone's staring at the wrong end of the yield curve. Now, layer this on top of the fact that the United States is currently running trillion-dollar annual deficits. Every single year, the Treasury has to issue massive amounts of new debt just to keep the basic machinery of the economy running. And someone has to buy that debt. For the last 30 years, Japan was one of the most consistent and, crucially, price-insensitive buyers of long-term U.S. Treasuries. They weren't shopping around for the best yield. They were buying because the carry trade math made it the obvious move, regardless of the rate environment. That's an enormous amount of reliable demand that quietly underwrote American borrowing costs for decades, and now that demand is softening. So when one of the largest historical buyers of U.S. Treasury starts pulling back, even gradually, yields have to rise to attract replacement buyers, new buyers who are not price insensitive, new buyers who absolutely will demand a higher return before they absorb America's debt load. And that's how you get a situation where the Fed cuts short-term rates and long-term yields don't move, or worse, they climb. That's called a steepening yield curve, and it's one of the most disruptive conditions a modern economy can operate inside of. Because when long-term yields stay elevated, the ripple effects don't stay contained inside the bond market, not even close. Here's where it stops being a bond market story and starts being your story. Because when long-term Treasury yields stay elevated, the damage doesn't sit neatly inside a Bloomberg terminal, it bleeds into everything. Stocks, mortgages, corporate credit, your 401k, the price of borrowing money to start a business, all of it. Let's break it down. When analysts build models to value stocks, they discount future cash flows using long-term yields as the baseline. When those yields stay high, the present value of future earnings drops, which means valuations compress, which means stocks trade at lower multiples, even when the underlying business is performing perfectly fine. That's why markets can feel unstable and jittery, even when the economic headlines look relatively calm. The problem isn't the headlines, the problem is the foundation underneath them. The 10-year Treasury yield isn't just some nerdy number that lives on a finance terminal. It is the price of money, and mortgage rates are anchored directly to it. So when people ask why mortgage rates haven't come back down to earth, this is why. The Fed can cut the federal funds rate all day long, but if global demand for long-term treasuries is weakening, the 10-year yield stays pinned. And when the 10 years stays pinned, mortgage rates don't magically drift back to 3%. Housing affordability stays strained, refinancing activity stays muted, home transactions slow down, and the American dream of home ownership gets quietly more expensive every year, not because of anything loud or obvious, but because of a bond market dynamic most people have never heard of. Cast your mind back to 2020 and 2021, when rates were suppressed and capital was essentially free. Companies were issuing debt like it was Black Friday and interest rates were 90% off. Cheap financing meant more deals, higher valuations, and aggressive expansion. Credit is the bloodstream of the corporate world. When it flows cheap, everything accelerates. When borrowing costs stay elevated, risk appetite falls, growth slows, and capital tightens across the entire system. And that's exactly the environment we're operating in right now, not because of anything the Fed did last Tuesday, but because the 30-year subsidy of cheap Japanese liquidity is quietly leaving the building. For 30 decades, the United States ran on a simple and largely invisible advantage, being on the receiving end of the world's largest carry trade, cheap Japanese capital flowing in, suppressing borrowing costs, inflating asset prices, and making the whole machine run smoother than it had any right to. That trade is unwinding, slowly, quietly, without a single trending headline. And the narrative being sold to replace it, that one Fed rate cut fixes financial conditions, that liquidity is automatic, that someone will always show up to buy American debt, that narrative is just flat out wrong. And it's dangerous because it keeps people looking at the wrong thing while the real shift happens underneath. The real threats in markets are never the loud ones. The loud ones are already priced in by the time they hit your timeline. The real threats are the boring ones, the ones hiding in plain sight inside Japanese bond policy and 30-year capital flow reversals. This is exactly what Finance Misfires is built to cover. Not to cover what's trending, not to recap what Nvidia did last week or break down the Fed's latest press conference word by word, but to shine a light on the structural failures, the money psychology traps, and the system-level shifts that actually move markets long before they show up in mainstream headlines. If that's the kind of content that actually makes you think, subscribe and bring someone else along who still believes one rate cut is going to fix everything. I'm Jimmy. I'll catch you in the next one.